After a long 2 years of house prices booming way above historical averages, things are finally starting to fall. And they are starting to fall fast. People can't afford to pay high house prices and high interest rate prices at the same time. What happens when there's less demand to buy real estate is the values of properties start to go down. Is this good? Is this bad? Is there a way we can still invest to build our wealth and profit? Let's jump into the studio and find out. In 2021, we could get a 30 fixed year mortgage rate for as low as 2.8%. If we were to put 10% down on a $500,000 property, you would be left with a mortgage of $450,000. At 2.8%, your mortgage payment was sitting around $1,906 a month. For the same priced home at current rates of around 7% in the US, you are looking at a monthly payment of $3,062. So you're paying over $1,000 a month more for the same house. So what are the Fed's options? They can continue to raise rates to try and tame inflation, but by doing that, they're making it harder for businesses and everyday people to borrow money, and they're pushing us closer and closer to a recession. Or they can pivot and start to lower rates, easing pressure off of people borrowing money, but running at the risk of inflation continuing to climb. Not a fun spot for J-Pow to be in. What we do know as of today is that the Federal Reserve will be looking at two things when determining interest rates: inflation numbers, and they're gonna look at the job numbers. If inflation and job numbers are high, they will continue raising rates. If they are low, then we'll ideally see rates go down. Should you even invest in real estate? Now, while we don't want to try and predict what the Feds are going to do, because that's always a losing game, what we really want to be focusing on, if interest rates start to go down, home prices will flatten and start to go up. Now, I've been investing since 2012, and I know that the federal government likes to kind of market split test what they're gonna do. So the Feds are currently talking really tough, saying they're gonna have to raise rates for an indefinite amount of time.
They're gonna keep raising. We're not quite there yet with inflation, and rates need to stay high.
Bruh.
What we know is that right now, rates are high, and eventually they're gonna have to come down. Very likely in the next 12 to 24 months. What the Fed usually says and does are two different things. It may be talking tough just to calm down the average person, or just to make more crappy headlines in the news to scare more people, but the CPI data that they keep basing their interest rate reports on is actually very, very lagged data. So real estate rentals and real estate normal house prices make up 40% of the CPI. So 40% of the entire CPI, which is what the government is making their choices on, is lagged data. A lot of smart economists are saying you gotta look at the live data, which is what, again, Cathie Wood is really great. I love listening to her stuff because it's really based on facts and knowledge and charts and what's actually going down in the live data, which is, we know for a fact that the major cause of inflation, the vast majority of the problem with inflation right now, was a slowed supply chain that went to a grinding halt for way too long, and businesses couldn't order and get their things in time, raising the price of wood, copper, metal, silver, food. Well, if you look at the live data that Cathie Wood recently posted on Twitter, manufacturing is lickety split. It's actually way faster right now and way less struggles than it was even before the pandemic, which is absolutely crazy. Cathie Wood predicts that we're gonna experience disinflation way, way, way faster than the Feds or even most economists can even plan for. We're probably gonna see 4% inflation by as soon as March, April 2023, and 2% inflation or less probably by the end of 2023, because we're gonna have disinflation so fast. The government can't keep these rates up for too long. They have so much debt. Feds are raising rates so fast and so hard, there's gonna be no growth, no GDP growth, no jobs. It's gonna be a catastrophe, and we're gonna see disinflation very, very fast.
Perfect.
They have so much friggin' debt that the longer these rates are up, they're coughing up way more money with their payments too, and they really honestly can't afford it. I'm not planning for a quick cave. We're planning our real estate business and all of our businesses for the long haul, but I got a feeling they're gonna cave pretty quick, and probably quicker than a lot of people are expecting. Patience, patience, patience. Patience is absolutely key, because what do we know from looking back in history and in the charts? Real estate always, always, always goes up over time. We're experiencing prices go down. That's not gonna last forever. You need to be buying your real estate properties with a long-term plan, and what I'm doing is buying with a 5-year plan, which is what I've always done anyway. I've been buying real estate always with that long-term mentality because we know time is your friend when it comes to real estate. It's beating out recessions, every single world war we've ever had, inflation in the 80s, which was way freaking worse than what we're seeing now. We're focusing on buying in very, very quality cities that are growing. There's job growth, population growth, rental demand increase in real estate prices eventually. A lot of you are looking to buy properties for refi. So maybe doing duplex conversions or buying a property, renovating it, and then doing a refinance. Unfortunately, for the most case, those days are over. So when it comes to different times, our strategies must change as well. So we're locking in that low price with the expectation to refinance 1 to 2 years from now and then selling in 5 years from now. That's the new game. So a lot of people right now are sitting on the couch waiting for spring, in a sense, when the market's finally gonna rebound, when the Fed's finally gonna pivot. We don't know when that's gonna be. Probably 10 to 20%, maybe 25% in some cities. That's an opportunity to take advantage of. Tight cash flow might be very tight. I've seen a crappy market like this. I've seen a tight and tough market coming off the 08 crash, which was a real major crash. This stuff is not even close to the same. Flat, boring, no growth, to slow growth, to possible decline. I've seen this before. You know what? It always comes out on the other end. So buy real estate in quality areas, just wait it out, and you will be rewarded. If you wanna dive further into how to invest in real estate, check out this next video or in the description. I'll see you in the next video.